We spent time talking about the idea of taxing investors on unrealized gains. Our next guest is looking at something we've also talked about quite a bit on this program, and Andrew's been talking about it for years. Bill Ackman recently talked about it with Jay Clayton, I think yesterday, the day before, and that's taxing loans related to the gains instead of trying to do it in a way that's probably not even possible to do. But Democratic Congressman Khanna of California, his 17th district is located in the heart of Silicon Valley, and anybody that doesn't realize that that is a goose that lays golden eggs constantly for this country and for the world. He's joining us today. Well, it says in your capacity as a surrogate of the Harris-Walz campaign. I'm going to forget that. I'm going to say you're joining us today as my and as my running mate. If we
bottom of the ticket, Joe Rowe.
No. Roe Joe. I want a cushy job where I don't have to do anything, but I can take credit for things. I want the.
We need you in the Midwest. Anyway.
But you tweeted it out to me, unsolicited, I think last week. What about this idea? And we've talked about it. It bears, I think, some consideration and a conversation. I immediately hear from other conservatives, we don't need to raise taxes no matter what.
Right.
But there are founders of companies that start with nothing. They have $5 billion. They die, and they pass it on to their heirs.
If you're using it as cash, it should be taxed.
It's never been taxed, ever. It's never been taxed.
But they're borrowing against it.
But they borrow against it, and the idea, and it's what you came up with.
Well, why
do you not want to do Kamala's idea? Well, or whoever came up with it. Why do you not want to do the Elizabeth Warren? Why do you not want to do that one?
Let me tell you why I don't think a blanket tax on unrealized gain is a good thing. I mean, let's say you're an entrepreneur. You create a company. It gets to 100 million or 200 million on paper. Now, if you're taxing that, you're probably going to force that person to sell it. They're probably going to sell it to private equity. Do you really want the entrepreneurs to be forced to sell their companies to larger institutions and to decline in value? I don't think that that's what you want for a startup ecosystem.
That would be the unintended consequence. Jeff Bezos wouldn't have to do that. They're going after these very, I think the whole policy is demagoguing to go after these people that they say pay less of a tax rate than their maid does, and they have billions of dollars.
I get why, but this is not the right way to do it. And also, 95% of investments in startups fail, and so you're going to disincentivize investments in those startups. But here's what I think we can go after. You have folks, they start to have capital appreciation, and then instead of realizing that, they take out a loan, which I call backdoor realization, to fund their entire lifestyle. They never pay tax on that. Then, when they die, they pass that money on to their heirs, and their kids never pay tax on that.
But let me ask you two questions. First of all, I think to make this actually work in practice, you actually also have to have the step up in basis at death. Otherwise, the entire effort doesn't really work because you need to change the incentive structure for why people would even want to take out these loans to begin with. Okay.
Totally agree.
There's a second piece to this, though, which is, and I actually was just on the phone with an entrepreneur in the Valley who I think everybody knows yesterday about this, who said, look, I understand what you're trying to do, Andrew, but if you do this way, it's going to disincentivize additional investment by entrepreneurs in the into either investing in their own companies or investing in other companies. So one of the things that a whole bunch of people who've made a lot of money do is they actually not only take out loans to fund their lifestyle, if you will, but they also take out the money to then make investments in other startups, in venture capital firms. By the way, venture capitalists and private equity folks often are taking loans against their own firms to look like they have carry in their funds. So their actual carry in their own funds is coming from a loan that they're getting from the fund. And so all of these folks are calling up everybody, including, by the way, the Harris team as well, because they're aware of this, because people are calling them saying, well, if you do it this way, you're going to actually be disincentivizing investments in small businesses, to bring it all back to today's conversation that Harris has now proposed. So what do you say to all of the pushback on that front?
Well, on your first point, it's absolutely correct on the step-up of basis. And that basically means you start with $100, it grows to $1,000, you give it to your kids. The kids should have to pay the capital appreciation tax. The second point, look, the easiest way is to tax luxury items and luxury items
as
purchases.
Like a VAT.
As a matter, you know, if you're going on luxury things at hotels and planes, luxury purchases, that should be taxed.